Hi, everyone. My name is Bill Donofrio. I work for Longbridge Financial. All I do, reverse mortgages. I've been doing them for 10 years. Absolutely love what I do. I will tell you this, reverse mortgages are the most misunderstood and maligned loan program out there. It is an FHA insured program. It is for people over the age of 62. And it is non-recourse. Now, what does that mean? You probably know as real estate professionals, right? But it means that you can never owe more than the property is worth, which was what Anne had mentioned. The amount of proceeds that you can get is tied to your age and the value of the property. Higher the value, the more you can borrow. Now, your age factors in. The older you are, the more you can borrow. Right? But it is all set in stone. And just like Ann said, it is highly regulated. The FHA they insure all the loans. So they set the level for all lenders. It's not like one lender can give you $350,000, the other one's only going to give you $300,000. Level playing field, because seniors need to be protected. Seniors were being victimized. Right? So what happens now? You're getting a reverse mortgage. Let's say, in Ann's example, you qualify for $300,000. We'll go two scenarios here. One, you have a mortgage that we need to pay off, and we will pay off the mortgage right away. So let's say that mortgage is $100,000, right? Which means you have $200,000 in a line of credit. Let's go the other way. Let's say you don't have a mortgage. Now all $300,000 is in this line of credit. The lines of credit grow, and they grow based on your interest rate, your current interest rate. Right now, it's about 7 to 7.5%. Think about this. You have a $300,000 line of credit growing at 7% per year. Use it. Don't touch it the first year. It's $321,000. Next one, it jumps about another $22,000. Think about this, one of the primary uses for a reverse mortgage is to provide for long-term care funds. The people who want to stay in their homes, they don't want to go to a nursing home. They want to stay in the home that they know and love in the neighborhood that they've been in for many, many years. And think about it, they get a reverse mortgage at 62. Let's say they have $300,000 in their line of credit. Let's say they don't need those funds for 10 years. That $300,000 credit line is now about $600,000. That's a lot of money, all right? People think that reverse mortgages are the loan of last resort. And I have staved off a whole lot of foreclosures in the 10 years that I've been doing this. But more and more, I'm finding that people are using this as a financial planning tool, right? To provide for long-term care later on. You don't need the money, that's fine. Just let it grow. One of the really good parts about this, you see I'm pretty passionate about this. One of the really great parts about it is your line of credit is going to grow regardless of what happens to your property's value. Let's say the property values start to dip. Your line of credit is still growing. Great hedge against a drop in real estate values. Another really good part, the changes that have happened in our program through the years, they are now very trust friendly. So we do them in revocables. I don't see many revocable trusts, but irrevocable trusts, no problem. We have them reviewed by our attorney. It just works very, very well for long-term care planning. It also, for people who have a sizable investment portfolio, rather than taking money out from the portfolio, especially when it's a down market, it's the worst thing you can possibly do is take money from a portfolio after it's been battered. Just throw something out here. Let's say you have, round number, $100,000 portfolio, and it takes a 20% hit. Well, now you have 80,000. Now that 80,000 needs to perform at 25% in order to get back to where you were. So let's compound this. Let's go with a 20% drop. Now it's 80,000. Let's say you take 10,000 out of it. Now it's 70,000. Now that 70,000 needs to perform at about 42, 43% just to get back to where it was. That's where the financial planning comes into this. It's very friendly with Medicaid. I'm not going to overstep my bounds and talk legalities, but you should absolutely speak with Ann about this. If you're planning on being eligible for Medicaid, certainly speak with Ann. Does not affect Social Security, does not affect Medicare. All the funds are tax-free. All tax-free, right? Lastly, there's a new article that just came out from the National Association of Realtors. Very conveniently, it just came out this week. I wonder if you could take a guess at which demographic group, which generation is buying the most homes now? Who do you think it is?
Gen X.
Gen X?
Millennials.
Millennials? And baby boomers, anyone? It is. I guarantee.
I feel like I've done the research.
Yeah. So for the realtor, any realtors, work with seniors. Part of the reverse mortgage program, you can actually purchase a home with a reverse mortgage. The really cool thing about this is that it's really good for people who are thinking about buying cash, or if they have a sizable down payment. Because when you have a reverse mortgage of any type, you're not making a mortgage payment if you don't want to. So So all you're paying, all you have to pay, your real estate tax, your homeowner's insurance, any HOA fees, right? So it makes a home more affordable. Seniors are seeing so much. It's difficult. It's really difficult for seniors out there. And I know because I speak with them all day long, right? They're seeing their investment portfolios get whacked. So they're very uncertain. And they're seeing unprecedented inflation, certainly in my lifetime, right? So it's a real squeeze that they're feeling. And many times the solution to their problems, to their financial problems, is contained in the four walls around them. So that's really about it for me. Any questions?
Does it work the same way with a condo?
Condos are available. Are available through the reverse mortgage program. We can do them. We need to see the bylaws to see if they are amenable to the guidelines.
Costs?
It's going to be about 4 or 5 months.
They've been saying that for 15 years.
There's a lender that's doing them. There's a lender that's doing them now. They're not doing them very well. They have it for a few months. We are going to have that program in about 4 to 5 months. Yeah, it's pretty cool. We're very excited about that. Anyone else?
Yeah, in the beginning, you said something about taking out a line of credit, and the line of credit grows if you don't touch it.
Sure.
When does that get invested? How is that?
Does not get invested at all. It is a contractual growth rate. It's not interest, because interest would be taxable. It is just, I'll tell you why this happened. 1989, Ronald Reagan was president, and he saw a couple of problems. He saw that seniors were having trouble making ends meet. He also saw that they had a lot of home equity. I'll tell you right now, senior home equity, people over the age of 62, have about $12 trillion in home equity. So there is a lot of resources there available to them, right? So back to Ronald Reagan. He wanted.
It was Bush.
Pardon?
It was Bush in '89.
It was last days of Ronald Reagan. Yeah, I believe that's what we've been told for many years. I would defer to you. No. Certainly. All right. So wanted to create a program where seniors could stay in their home and get access to money that would not be a drain on public coffers. So the reverse mortgage program was devised. Not only you provide a lump sum if they want it, but the credit line would grow. Now the growth rate of the credit line is the same rate as the rate of interest plus 0.5% for FHA insurance. Right now, that rate is about 7.5%.
What does that mean? If Mr. and Mrs. Smith own their home and it's valued at $1 million, they would conceivably take out a first mortgage for $300,000 set up in the line of credit. They don't touch it, and it just grows. In 10 years, it might be worth $500,000.
Absolutely. Yes, that is absolutely.
It's not worth $500,000.
That's the draw on it.
Your liability grows.
Yeah.
Yeah. Well, your available funds would grow. You're only paying interest on the money that you've taken. All right. So if you haven't touched it, let's say you start with only your loan costs. All right. So let's say it's $25,000 or $30,000. All right. That's growing at 7%. So it's going up about maybe $2,000 a year.
Growing as a liability, you mean?
That is growing as a liability.
You explained it, you think we were getting interest on the money.
Right.
Please let me finish. Okay. So your loan balance, $30,000, growing at 7%. That's about $2,000 per year. Your line of credit is $300,000. That's growing at 7% per year also, which is about $20,000 a year in growth. So there are two parts to it. It's what you owe, and it's what you could take. And if someone passes away without touching any of the credit line, all they owe is what they have taken and the interest that has accrued.
What is the ratio, the safe ratio you would allow on $1 million house? Is it 40% of the value? Is it 50, 60, 70? What is that?
How old is the borrower?
Give us a
Age is a factor. Age
65, would say.
Right now, 65-year-old borrower, $1 million home, probably about 350,000.
So it's 70% in the hedge to protect them, obviously.
Right. Well, you know what? The FHA insuring these loans, the FHA does not want you to be underwater. They don't want you to be underwater. They want you to be able to leave a legacy.
But they're all actuarial assumptions, like they're done by actuaries to make sure that it's
Absolutely.
12 trillion and so on.
Yes.
Beside your drawing power going up with a reverse mortgage and the ease of getting it, what would be the difference between that and a HELOC?
That's an awesome question. Yeah, HELOCs they're cheaper. They're absolutely cheaper.
Those are home equity line of credit.
Yes.
Yeah.
Thank you. I appreciate that. Okay, home equity line of credit. So you get it from the bank, and you get, let's say they're giving you a line of, say, $200,000 when your home was appraised at $800,000. Right? It's a nice tool. But what happens when your home goes down in value like it did in 2008? I'll tell you what happens. The bank has every right, and they did, to call the loan. They would say, you know what, that 200,000 line you had that you were counting on, it's not 200 anymore. Now it's 100. Okay. No matter how much you need that money, no matter how much you were planning on it, it was taken away, and they had every legal right to do so.
That's for the HELOC.
That's for the home equity line of credit. With a reverse mortgage, that can never, ever happen. Never. Your line of credit is going to grow every single year that you have that loan.
Even if housing prices decrease.
Absolutely.
That's the FHA insurance.
That's the FHA insurance. So it also guarantees that you're not going to owe more than your home is worth. And by the way, when the last borrower passes away, if they have a reverse mortgage, their heirs will have up to 1 year to settle the loan. Right? Two scenarios. Right? I'll make them quick. Right? You have, let's say, when someone got the loan, the home was worth $800,000. They took out 200, and now it grew to 300,000. Let's say the home is now 900,000. So at the closing, the lender would get their 300,000. The heirs of the borrowers would get the rest. Right? Great deal. Now let's say worst case scenario. Now you have a home that has decreased in value, and now the loan value is up here, the value is here. The heirs can walk away and give a deed in lieu of foreclosure. That's an option to them, right? They would not owe the difference between the two. All right, that is what the lender would be made whole through the FHA insurance. Right? Performance markers, if we don't, they just don't give a year. There are certain things that need to happen. The extensions are given in there's a 6-month extension given first, then there is a 3-month extension, and then there's one final 3-month extension given. And that's how it comprises the year. Yes.
Somebody else has a question. What happens if probate takes longer than a year and you cannot sell it until you have a letter saying
It happens. That's how reverse mortgages go into foreclosure.
Can I jump on that?
Absolutely,
So,
please.
if there is a probate nightmare, you can ask for what's called preliminary letters testamentary, and that would enable a sale to occur, and the proceeds go into a lockbox until the court has finalized the full probate.
Perfect. Thank you.
Questions. If the reverse mortgage is sold, it's good for the person taking the reverse mortgage. How is the lender making money? What's in it for them?
Well, the lender makes money on the interest that is accruing on the loan. Let's say the loan is active for 10 years. At the end of the 10 years, the lender is going to collect that interest. They're going to collect everything, the principal and the interest that is accrued. That's how they make money.
Payment? Is it a balloon payment for you?
Well, you can pay off a reverse mortgage whenever you want, right? And there is never a prepayment penalty. You can also, which is really kind of cool, I probably have about 20% of my borrowers now actually making payments on a reverse mortgage, right? For the first 7, 8 years of doing what I'm doing, I never saw this. What they're doing, though, is it's really smart. Let's say you want to make $1,000 a month payments on a reverse mortgage, right? 2 things happen. 1, your balance goes down by $12,000, right? But at the end of the year, it goes down $12,000. What happens on the other side with your credit line? That jumps up by $12,000, and it's getting that growth on top of it. So it's a way of better managing the loan balance. So to make it easier for your heirs to take it over, right? And secondly, it's giving access to even more funds that you may need in the future, maybe for a long-term care event.
Have reverse mortgages been sold? Do they sell them as well? Are they being CMBS or no?
Oh yes, absolutely. They're securitized, absolutely.
Bonds and all around the world.
Yep.
Could they be closed at any time? The line.
The line? No. Well, as long as you stay in good standing with the loan, right? You need to pay your real estate taxes on time. You need to pay your home insurance, homeowner's insurance on time. Live in the home is your primary residence, which means that you need to be there 6 months and 1 day per year, right? And it's also keep the property up to minimum FHA standards. And like the way I like to put it is, don't let the place fall down around your ears, and you'll be fine.
What would happen if the house went on fire and you couldn't live there?
Well, that would be an insurance claim when we do a reverse mortgage, just like any other mortgage. We are named as payee on the homeowner's insurance policy.
And you don't have to take out additional insurance to cover that or anything, or there's no policy.
Nope. We are listed as a payee. Anyone else?
If we have no other questions, I want to thank these 2 industry specialists. They gave us a lot of information today. It's like drinking from a fire hose, but just know these are the 2 best in the industry. They have their information in the packets. Bill had provided some lunch for us too, so thank you both for your time today.
Thank you.